whole life is a savings alternative, not an investment alternative. That's where people like this guy get it wrong.
It's another retirement account. It's like a Roth IRA.
Get sucked into their sales pitch. Don't beat yourself up.
Pay it forward to the next generation. It's not necessarily about estate taxation. It's about estate preservation.
Whole life insurance applies to, that is not, can I have someone assist me in purchasing this that is not a commissioned salesperson? How would I go about doing that?
Not very easily. You can't. They're trying to move in a direction where insurance sales may be commission free. But there's not very many of those out there. And there aren't a lot of people that advise primarily on insurance. So if you want this, you're going to have to buy it from a commissioned agent. And that's okay. You buy your car from a commissioned agent. Mm-hmm. You go down to the Ford dealership and you buy an F-250. That guy it knows all about F-250s. He's going to tell you about all the features. And he's going to tell you, it's better than the Chevy because of this and this. The Chevy's a little better here, but overall the Ford's a better deal. And you know that, and that's okay. And you buy the truck from him. That's fine. Right? That's not a bad thing in life. Lots of people make money with a commission. There's lots of people out there that are real estate agents. They get paid on commissions. That's not an evil thing to get paid on commissions. You just got to recognize that if your question is, should I replace my car? And you ask that question to a car salesman, the answer is yes. And you should replace it again next year. You can't ask him that question.
It's not even about the commissions. What this is about is, he said it a couple minutes ago, is it's on you to really understand what you're getting involved with. You should never put your money into anything that you don't understand 100%, right? And so if that means it takes you a little more time to educate yourself and ask questions and whatever, there's nothing wrong with somebody making a commission. I mean, I'm a licensed agent. I'm not going to hide that. I've been licensed twice in my life. I actually gave up my license so I could actually focus more on just educating people for a while. And, from 2016 to 2022, I literally, if you go back and look at the history of my channel, I spent a lot of my life just focused on educating people and helping advisors build their businesses and helping life insurance agents build their businesses. And the reason I did this, because I did not want the stigma. I actually had a mental block and a self-limiting belief that if I was licensed, I couldn't show up and do what I believed in the most, fully authentic way, right? And so for me, it's one of those things where I look at this and I say, all right, it's true. Some people are going to be commission hawks. That's what they're going to do. There's no getting around that in anything you do. That you could go to people selling mutual funds and stocks and money management and all these different things. There's people that do that in every way, shape, or form. He's 100% right. You are not a fiduciary as a life insurance agent. Now, I am a licensed life insurance agent, and I also run a private equity fund. And so I have two different silos, and this is how you have to understand it, is I don't have a fiduciary responsibility, technically speaking, as a life insurance agent. I'd like to think that I'm better than most fiduciaries when it comes to my integrity, my ethics, and how I'm trying to authentically help people. But when I'm over here in my private equity fund, I absolutely have a fiduciary responsibility. Challenge is, what I do over here doesn't really have any bearing on my life insurance business. I just got to make sure I fully ethically manage everything, right? And I disclose and I disclaim every single thing, right? And if you focus on education and you're willing to go slow and you don't need to jam people through for commissions, it can actually be a really solid solution for a lot of people. The thing that I think is really, really sad is that this guy's giving this advice to doctors to not get whole life insurance when, in fact, because of all the reasons I showed earlier, whole life insurance could be potentially the best solution for them. And I don't know why he's so angry about it. I think he's, like I said, I've said it a couple times now, and I'm going to say it again based on what he's just been talking about. He mentioned Northwestern Mutual and New York Life because they don't train people to do it this way. The history of the past of life insurance agents where things got really bad, where the reputation kind of became a little bit used car salesman-y, because the career model, meaning you go and you work for Northwestern Mutual and you're captive, or New York Life, or Mass Mutual, or Penn Mutual, or National Life Group, or any of these big mutual companies that had career models where you go work for them. You were like a W-2 employee. You were captive. You had to work for them and sell their product, right? Still paid on commission, but that's all you could sell. You had to follow their training and do their thing and their product, and they didn't teach this stuff. So what's happened is the whole model of the insurance business has gone more independent facing. And what that means is rather than relying on the companies, people are relying on having to go out and do their own training, get their own education, and learn their own thing about how to sell these products and about what problems these products solve and who they're best for and all these different things. That's where people like me come in, and we train agents how to do that, right? And so when you see all these different solutions that these products can have, and you're like, why is there so many people right now? Why is there such a growth of all these people talking about insurance in all these different ways? It's in direct correlation with the expansion of the independent model in the life insurance business industry as a whole, right? We're going away from the career model, and we're expanding the independence model. And that's where you're seeing the big shift in this. So I felt I had to say that, for everybody who's watching this and doesn't really understand the industry fully.
Should I buy a policy? You can ask them to tell me about the features of this particular policy, or if it's an independent agent, you can tell them this is what I want to do with the policy. What policy is going to be the best one for me? But if you ask them, do I need a $20,000 a year policy or a $30,000 a year policy? The answer is $30,000. And you just got to recognize that huge conflict of interest when you're dealing with a commissioned agent and not a fiduciary.
Never ask the agent how much you need to spend. Ask them about policy design and learn enough about this stuff to ask the right questions. If you're just asking about premium, that's just uneducation on your end, and buyer beware.
Financial advisor that you're paying a fee to give you, unconflicted advice. That is not what you're getting when you're talking to somebody who sells these policies. And chances are, despite the fact that, you mentioned your example, and I've had the similar experience, of your lawyer sending you to a financial advisor, it really wasn't truly a fiduciary you were sent to. It was a salesperson masquerading as a financial advisor. So if you want to know what somebody really is, you got to look at how they get paid. Did they get paid on commissions? If so, they're a salesperson. Do they get paid fees for their time, like an attorney or an accountant or a fee-only financial advisor? Then they're going to be a heck of a lot more fiduciary to you. So you just got to understand how people are paid and not be naive, and this is the problem with doctors, right?
Sure.
We assume because when we call up a GI doctor to get their opinion about what we should do with this patient that's vomiting blood, that they're always thinking about what's best for the patient. We assume that when we call up an insurance agent that they're operating under the same standard, and they just aren't. That's not the way the business world works. And it's a huge eye-opener for doctors when they learn that.
So, Jim, I feel like I could ask these questions, but I feel like it'd be more fun to just kind of let you rip through this. What are some of the biggest myths, like some of the biggest sales points that tick you off the hardest in the sales pitch from these folks, and what's your rebuttal to them?
Okay, well, let's talk about some of the uses people use to try to get you to buy this stuff, right? Here's one of the common ones they throw out there. You need this for estate planning purposes. Okay, well, there are some estate planning uses of whole life insurance. I mentioned one earlier with the irrevocable trust. But most people do not have a complicated estate. They don't even have to pay estate taxes, right? You can die today. If you're married, you can die today with like almost $26 million in your estate and pay nothing in federal estate taxes. Pay nothing, right? So let's say you're a millionaire now, you got $1 million and you might die with $8 million. You're not going to have an estate tax problem. So this guy's trying to sell you a solution to a problem you don't even have.
But it's not just an estate tax issue. It's an estate preservation issue, right? Like having money in a whole life insurance policy there's a buddy of mine, Tom Wall, who's a PhD in retirement planning income, wrote a book called Permission to Spend. And he mathematically showed you cannot optimize retirement planning when it comes to transitioning. If you value transitioning your legacy to the next generation, which I do. So maybe this is just a shift in values. Maybe it's a difference in values that this guy and I, have with each other. I value the fact that it's my responsibility to kind of pay it forward to the next generation, and he doesn't. I don't know. But you cannot optimize retirement planning when it comes to planning for income without having a whole life insurance policy in place. If you value legacy planning, if you value making sure that you're going to, pay it forward to the next generation. It's not necessarily about estate taxation. It's about estate preservation. So just once again, I understand what he's saying, where agents sometimes misrepresent that, but it is what it is. He's not wrong, but he's also not right.
And even if you had an estate tax problem, it's not like the insurance is the only way you can pay for it. The person who needs, whole life insurance for an estate tax problem is somebody that has they're worth $40 million and 35 of it is in the family farm, right? How's this guy going to pay his estate taxes? He's not going to have any liquidity when he dies. And he wants to split that farm between two people. Well, now he might have a need for whole life insurance. But Joe Blow, doctor or lawyer or engineer who's going to die and be worth $8 million, and most of it's in liquid assets, this is not a problem. You can pay you don't owe any estate taxes. And even if you did, you could pay them out of your liquid assets. So no big deal there.
I have a question. I have a question on that. I know I said I was going to let you, but I do have a question there. You in the article that I read that inspired us to ask you to come on the show here, you say that if you are trying to get a permanent death benefit, for example, in that use case, that there are still better products than whole life insurance, such as guaranteed no lapse universal life insurance. Can you explain what that is and what if that's still your stance right now?
Sure. The difference between the two. Okay, universal life is this incredibly flexible permanent life insurance policy, a cash value life insurance policy. You can do all kinds of different things with it. So you see variable universal life, and you see index universal life, and you see straight universal life, and you see guaranteed universal life. And what a guaranteed universal life policy is simply a lifelong policy that does not accumulate cash value. And you pay the premium every year, starting whenever, 25 or 35 or whatever, until the day you die, and then you get whatever the benefit is. It might be $1 million benefit. And compared to buying a whole life insurance policy that does accumulate cash value, it might cost about half as much. And so if that's what you need, is a definite amount that's going to be the same no matter when you die, whether you die now, whether you die in 50 years, if that's what you need, guaranteed universal life is a cheaper way to get it than whole life. Now that whole life policy death benefit, assuming you always reinvest the dividends that it pays out, its death benefit will actually go up over time. And so you might be buying $1 million death benefit, and by the time you die 50 years later, it might be $2 million. Whereas that guaranteed universal life policy is still going to be $1 million. So that's the difference between the two, but it costs half as much. And so, you ought to look at all your options. If you're going to get married to a permanent life insurance policy, you ought to really understand all the options and what you can get.
He's not wrong.
Okay, another use case that people will sell you on, which I think is one of the dumbest ones, is to pay for college. I mean, most of these policies out there don't break even for 15 years. That's just getting back to the total of your premium.
Again, first of all, I love this for college. I've done a video on utilizing whole life insurance as an alternative to a 529 account. And the reason is because, well, I'll tell him my reasons in a minute. I want to see what he says first. But I mean, his answer, the reason these policies don't break even for 15 years. I just showed you the break even in 5 years, and you're going to be ahead in 15, 20 years, they're going to be way ahead. So if you were to do this for your kids when you start, but the most important part is when you do college planning, remember, you got a 2-year look back period. So you want to make sure all your college planning is in place by the time your kid's like a sophomore in high school. And the whole purpose here is when you have money in a whole life policy, it doesn't go against your expected family contribution. So it's not just about how much money does the account make. It's about reducing your EFC to reduce the sticker price that you pay for college. Most of the time, if you go to school and the sticker price is $60,000, if you save in a 529 and you have all this money coming out your ears, especially if you're an entrepreneur or real estate investor or something like that, well, then you're going to be paying $60,000 a year for your kid to go to school, right? If, for instance, you have money in a whole life policy, that's not going to show. And if a couple of years before you organize your assets in a way where you reduce your income, you can reduce your EFC, all these things come into play, you can actually get massive grants and reduce the cost of college with the right planning and cut a couple $100,000 off the cost of college. So it's not just saving for college, it's saving on college. And you've got to calculate those returns on what you can get from a reduction of sticker price on everything. And if you want, I'll put in the description below, I'll put a link to that webinar. It's a couple of years old at this point in time, but the principles don't change. So just keep that in mind.
Premiums paid. And so they're like, oh yeah, buy this and you can borrow against it for college. And, it's great. Well, it's not great. You break even after 15 years. That's when you need the money. It hasn't grown. You basically had to save up everything for college. Your money didn't do any of the heavy lifting. You're far better off buying a rental property and using the income from that to pay for college, or selling it and using the proceeds to pay for college, or using a 529 account to pay for college, where you actually expect the investment to grow as you go along. Then you are buying a whole life insurance policy to pay for college. So that's one of my particular pet peeves. I think it's a terrible use of a whole life policy. The most common one though is retirement. It's another retirement account, is what they tell you. It's like a Roth IRA. Because it does grow in a tax-protected way. You don't pay tax.
I don't know anybody that says a whole life policy is like a Roth IRA. People say that about IULs a lot, and IUL and whole life get mixed up a lot because there's so many idiot IUL agents out there that misrepresent what it is.
as it grows. But it's nowhere near as good as a retirement account. Now, so if you've already funded all that stuff, you've maxed out your Roth IRA and your spouse's Roth IRA and your 403B and 401A and 457B at work, and you've done everything. And then you go, well, how else can I save for retirement? Let me introduce you to something, okay? You can just invest. You call it a taxable account or a brokerage account, or you can go buy some rental properties. There's no limit on how much you can save and invest for the future. There's only a limit on how much you can put in retirement accounts. So once you max those things out, you don't have to go, oh, I guess I'll have to buy whole life insurance now. You can go buy some rental properties. You can buy a real estate syndication. You can go buy, a total stock market index fund in your Vanguard.
What I find funny about this is that the income limits for Roth IRAs are $240,000. So for most doctors in this country filing jointly, they're not going to be able to qualify to contribute to a Roth IRA anyway. He's probably going to talk about a backdoor Roth or whatever, but even that, they've talked about like shutting down the backdoor Roth IRA as it is as a whole anyway. And so, once again, this stuff, it's just so frustrating to listen to for me.
Brokerage account. There's no limit on how much you can invest in a taxable account. And the truth is, because the returns on whole life insurance are so crummy, you are almost always, especially early on, you're almost always going to be better off if you are investing, getting a more traditional investment, whether that's stocks, bonds, real estate, whatever. Most people don't realize the returns on whole life insurance. You buy this policy, right? You're buying it as this investment because you're going to hold on to it the rest of your life. Okay. And it will guarantee you returns. If you hold it for the next 50 years, the returns it guarantees are about 2% a year. That's what it guarantees you, 2% a year. That's not even inflation, right? That's a terrible return for something that ties your money up for 50 years. The projected returns come in at around 5%. And in my experience, most people end up with something between those two. So 3 or 4%. Is that awesome? No. Is it acceptable? I guess if you're okay with that, holding on to something for 50 years. But if I'm going to make an investment for 50 years, I want to earn a whole lot more.
But you're not investing in a whole life policy. Remember, you are saving and you're utilizing the capital for other investments. You're buying cash flow producing assets like real estate and you're leveraging it. So it becomes an accelerant on top of the investment. It becomes a system that puts you in a place where you have discipline to be able to save and put money into that. You are not investing. Whole life is a savings alternative, not an investment alternative. And that's where people like this guy get it wrong, even though he kind of speaks about it in the right way sometimes. Like I just get confused about where he's coming from. So anyway, let's keep going.
More than 3 or 4% on it.
You keep saying buy a policy. The way that you're phrasing it is that this is a one and done purchase, but that's not true. This is a multiple, like you're paying every month forever, right? For this policy?
There's lots of different ways to buy a policy. And I'm a fan of the ones that allow you to fund it quicker rather than more slowly. You can pay for the rest of your life. That's a very common way that these policies are sold.
I'm not a fan
but the general rule, if you want to get the best return off the whole life insurance policy, is to fund it as quickly as possible.
Can we say least bad return?
Least bad might be the better way to say it. But you want to use paid up additions, as I mentioned earlier, and you can actually get what's called a 7-pay or a 10-pay policy where you're done after 7 years. You pay big fat premiums for 7 years and then you're done. And you don't have to pay any more premiums. But that's not what most policies sold are. Most of them, you're right, you pay every year. So all you're doing when you're buying the policy, yes, you're making that first payment, but you're also making a commitment to future payments. And that's what drives a lot of people nuts. They've had this thing for 5 or 6 or 7 years. They look at it and they're like, man, I haven't even broken even on this thing. And I don't have the money I need. I want to go on vacation with my kids. I need to save for their college. I'm not even maxing out my retirement accounts because all my money's going toward this stupid whole life policy. And that's when they get mad. They calculate their return. They realize it's still negative. And then they come to me going, should I dump this policy?
So this is the next question, right? Is what do you do if you're in that situation?
This is hard because the truth is that the worst returns are heavily front-loaded. Right? It takes you 5 years, 10 years, 15 years to break even, depending on how the policy is designed. And those are the worst returning years. If you go buy a policy and you turn around and you want to get rid of it a year later, your return might be minus 40%, right? Minus 33%, something like that. That's what you get back if you dump this thing after a year. Where did that money go? It went to the commission. The agent that sold it to you, that's where the money went. And he has to be paid whether you dump it in a year or whether you keep it for 50 years. And so the early returns are absolutely terrible. And you got to realize that. But if the long-term returns are 2% to 5%, well, there's got to be some better returns in there somewhere, right? If the bad returns are in the beginning and the good returns come later. And when I say good, less bad is probably the right way to describe it. But what you have to do when you're deciding whether to dump a policy, even if you never should have bought it, is you have to decide, is the return going forward acceptable? And the way you do that is you get what's called an in-service illustration or an in-force illustration. And what that does is it projects returns going forward and shows you what the guaranteed returns are going forward from that point.
All right, so he's not wrong with that. That's a really, really good way to do it. So what I want to do here really quickly is I actually want to go through, my lighting is changing because it's going so long here. The sun behind me is going down. So what I'm going to do here is I'm going to actually pull this illustration up that I want to show. And the reason I want to show this is because of the fact that he talked about the fact you could do a 7-pay. So I want to talk about it. I just took the other illustration I did. I made a couple little tweaks to it while he was talking, and I have this going, and you can see at year 8, so year 7, it's there. This is fully paid up. So you can see here, I had a $1,619,000 death benefit, and it drops down to $378,000. Now, what did I have here? I got basically 100 plus $67,000 more, 167,000 or so, and I've got $187,000 of cash value, right? So I'm way ahead at this point in time, and you can see at this point in time, every single year, there's no more insurance charges, there's no more expenses, there's no more anything, and you can see that every single year, the increase in net cash value is going up by over 4% every single year, and that's just the way it's happening. And by the way, the older the policy gets, the more mature it becomes, the better that becomes, right? Now, so you know, with a whole life insurance policy, you can do this. You are not obligated to this. I broke this up in this illustration to show you that you have the flexibility to do this starting in year 8. This is the same exact illustration that I showed in this other illustration that I showed earlier in the video. The difference is I just went into the illustration and I showed reduced paid up, and this is what it came up with. The policyholder has the flexibility anytime after year 7, they can reduce pay up the policy if their life changes, if their financial needs change, if anything of that nature changes in their life, they can do that. And so it just goes to show you that these things are way more flexible than most people, let you know. And so that's that.
And some people that wish they'd never bought their policy, that do this after they've had it for 10 or 15 years, decide, going forward, it's not too bad. I expect to make, 4.5%, 5% off this thing. And they just decide to keep it. And that's not uncommon at all, that they keep something they wish they'd never bought in the first place. But a lot of people that are 4, 5, 6, 8 years in, they go, I've still got a better use for my money. I've still got 8% student loan.
Once again, you could borrow against the policy if you have 8% student loans, refinance your student loans through the policy, right? Pay the student loans off at a cheaper rate. So what's the value in saving that rate of return, right? Do that. Never interrupt the growth of the policy as you pay your student loans back. I guarantee you that will create more wealth. Why is he missing this? Like, how's he speaking out of both sides of his mouth? Mind blowing to me.
I got this stupid whole life insurance policy. They dump it, they take their cash value, and they walk away. Obviously you should get term life insurance in place first if you actually have a legitimate life insurance need. But, I walked away from my whole life insurance policy after 7 years, and I have zero regrets about it.
Okay, I was going to ask, you are incredibly knowledgeable about this. There is a clear determination to know every in and out of this, so you can beat down every argument that a salesperson would come through and have this. It sounds like you used to have a policy. I can guess whether you have a policy now or not. But can you walk us through your experience with that?
The truth is,
my guess is he had a full base policy.
I would not be opposed to buying a policy. If I had a need for a policy, I would buy a policy. I'm not against it. I'm not particularly easy to insure. I have a few bad habits. I like to go scuba diving. I like to fly. I like to go rock climbing and mountaineering and that sort of stuff. So a policy is not terribly cost effective for me because I'd have to pay more for the insurance. But if I needed one, I'd buy one. If I had an estate planning need or business need or something, I wouldn't have any problem whatsoever buying a policy. The problem with the one I bought was it was completely inappropriate for me. It was sold completely inappropriately. And that's the way most policies are sold. They're sold to someone who doesn't really have a need for it. The wrong policy is sold. It's designed to maximize the commission to the agent. It's not designed to help me or give me the best possible return or anything like that. So here I am. I'm a medical student. I have no income. Right? No income. I have no assets. And I get sold this little tiny whole life insurance policy by my friend, that I trusted, who was a summer intern with Northwestern Mutual, and this is a very common scenario for people. Yes, and, he told me all the great things about it. And I said, well, I certainly want to be financially responsible, and I'm married now. I should have insurance. And so I bought it. And I calculated my return after 7 years on that policy. And part of the reason the return is so terrible is because it was a relatively small policy. Part of it was I didn't actually buy a policy that was designed to give a good return. It wasn't a good policy to start with. But anyway, my return after 7 years was a cumulative minus 33%. I was still, after 7 years, I had not broken even, and I was a long way from breaking even.
So for someone who doesn't understand what minus 33% means in this context, when you stopped paying for the policy, did you just lose everything? Did all the stuff you put into the policy go to zero? Was there some benefit? Were you able to extract some value from the policy and closing it down?
I don't remember what the exact amount was because this was a small policy, but let's just say for simplicity's sake that it was $1,000 a year is what I was paying. So let's say I've paid in now, it's been 7 years, and I paid $7,000 in premiums. And what I probably walked away with at that point would have been something like $4,500, $5,000. So there's something there. You don't walk away with nothing, but you've still lost money. It's not like it's been a good investment. 7 years, you tied your money up and you have a negative return on it. That's hard to get excited about it as an investment.
And is this cashed out at that time when you close down the policy? Is there a taxable event?
Yeah, you're surrendering the policy, and that's a taxable event. In my case, I had a loss. So there's no taxes due, right? The basis for that cash value is the total amount of premiums paid.
Mm-hmm.
And so I had a loss, so I didn't know any taxes. If you've had it for a long time, you may have a little bit of a gain that you have to pay ordinary income tax on. But the truth is, if you've had it long enough to have a gain, you may want to keep it. Not to avoid paying taxes on the gain, but just because you've gotten past the crappy return years. But that takes a while. Some policies, you might be 15 years into it before you've actually broken even.
Have you noticed that in the concept of trying to break up with your whole...
That is true. And by the way, we've helped a lot of people in those situations shift and 1035 exchange money into a good policy, because what a lot of people don't realize is that if you 1035 exchange money from a policy that's designed improperly, but you're in a situation like he's in, and you want to 1035 exchange the cash value you do have rather than surrender, probably no taxable event anyway because of the fact that you're going to be negative still. But B, what you do is you lock in your cost basis, which from a long-term perspective, when you go to take income in retirement or utilize it as a volatility buffer in retirement, then you are able to withdraw up to basis so you don't have any loan expenses in retirement. That's a really, really powerful strategy that I think a lot of people don't know about. And so by 1035 exchanging money, you have the ability to do that. And so anyway, here we go.
Life insurance policy. I imagine that this also, in many cases, comes with a breakup with the financial planner who sold it to you and may manage much of your assets. Have you come across that scenario?
Yeah, that's a lot harder situation, right? Because not only do you have to fire the advisor and get rid of the policy, but you got to deal with the fact that you trusted somebody and then they sold you something that maybe wasn't very good for you, and that's painful. Number one. Number two, it's hard because you maybe don't feel competent to do it on your own yet. So anytime you fire a financial advisor, you should first get the plan in place of what you're going to do after you fire them. And if that's using another advisor, go get that advisor first, have them help with the process. And they can. True. They just pull money away from the other advisor. It's no big deal. They send them a form, they send them the money, sign a paper saying I'm done paying you if you're paying a regular fee to them. And then you can deal with the insurance company directly as far as dropping that policy or cashing out that policy or whatever you choose to do with it. If you're going to do it yourself, you need to get a written financial plan in place. If you're going to be a do-it-yourself investor, you ought to be able to write this plan yourself. If you're not going to be a do-it-yourself investor, well, go hire good advice at a fair price and then let that person help you. But yeah, it's definitely more complicated if you thought this person was a real financial advisor.
Yeah, I think that has been the case. I had a conversation with someone recently who unfortunately was in that situation where I think their eyes were open to the incredibly expensive life insurance policy that had been sold to them by their financial advisor, plus millions of dollars, a couple million in assets under management with that financial advisor. And the conversation was, I think you should go and hire a fee-only financial advisor, perhaps using a platform like XY Planning Network. We have no affiliation, but like those guys, pay them a fee, which could be thousands of dollars to put together that plan, and then figure out the transition plan. And that's a very painful, scary, anxiety-producing exercise there.
Absolutely, but extremely empowering once you get to the far side of it. And what you need to realize, if you're, if the listener is out there thinking, that's the situation I'm in, crap, I got to do this now. Let me promise you, there's light at the end of the tunnel. Almost everybody goes through this process at some point. And so don't feel like you're alone. We've all done it. I've done it. I've done it at least twice, before I really became financially literate. Almost every white coat investor has done this. They trusted somebody maybe they shouldn't have trusted. They bought something maybe they shouldn't have bought. And you've got to transition out of that. Otherwise, if you do, think about the consequences if you don't. It's going to be terrible if you're still there in 10 years.
Yeah, it's really unfortunate here. How do you think these people feel Jim, when they become aware of the terrible investment that whole life insurance is, and maybe the other problems with their financial advisor that are contributing to these large expenses or big losses?
I mean, you're going to feel like I felt. You're going to feel like a schmuck, right? And there's no way around it. And this happens all the time with my audience, neurosurgeons, interventional radiologists, these are not dumb people, right? They're very smart people. But they maybe didn't have the best understanding of how financial products work, and they interacted with an industry which is designed to take advantage of them, that views them as whales to be harpooned. So don't feel like it's 100% your fault. It absolutely is not. Nobody learns this stuff in high school and college. You have to learn it on your own.
True.
And even very smart people make these mistakes. So don't feel like you're, a hopeless case or beat yourself up too much. Beat yourself up just enough to fix the problem.
Yeah, I want to highlight that. You're working, I don't even know what an interventional radiologist is. I follow several doctors on Twitter, and I'm like, don't know that term, don't know that term. But doctors are intelligent. You specifically, you're in emergency medicine. You don't just specialize in one thing. You kind of have to know a lot about everything and then call in the experts. And that's what you do with your finances too. Maybe you don't have the time to manage your finances by yourself. So you call in an expert, and they talk a really good game. They're salespeople for a reason. They're making $30,000 on one life insurance policy for a reason, because it's a lucrative thing for the insurance company. So when I don't want to say get sucked in, but that's a really great phrase, so I am going to say it. When you get sucked into their sales pitch, don't beat yourself up, but also don't sit there and say, well, I guess I'm stuck with this now. You're not stuck with it. You're not stuck with the financial advisor. You're not stuck with the crappy policy. You have to make a change. So empower yourself. Understand that even smart people like doctors and attorneys, and even smart people, get sucked in by a really great sales pitch. I've been sucked in by great sales pitches. You cut your losses and move on. And what is that? What is the sunk cost fallacy? You have already lost this money. Don't continue to lose more. You have already paid these premiums. Don't continue to pay more. If your financial advisor isn't performing, you have already lost out on gains that you cannot get back. Don't continue to lose out going forward. The XY Planning Network is a great place to find a fee-only financial advisor. What's a fee-based financial advisor? You mentioned that at the very beginning of the show. I didn't even know there was a fee-based. I thought it was either the commission-based or fee-only. That's another fun thing. So make sure you're getting a fee-only financial advisor. But they aren't that expensive. Scott said something about thousands of dollars. I think Kyle Mast, when we first interviewed him, it was like 5 years ago, but when we first interviewed him, he was something like $800, $1,000 to review your financial situation and your goals and give you an idea of what you should be doing. In the terms of financial independence, that's like a drop in the bucket.
I mean, yeah, I'm more commenting on that in the context of perhaps a transition of this sort might involve a lot more work to break up with an existing financial advisor, move large amounts of assets that are in or out of retirement accounts to a new plan, make sure that there's no tax event when that happens, to make sure that that's done correctly. That may be a few $1,000s, but if you have $2 million in assets under management with your financial planner and a $50,000 a year policy, that person's already made 40 grand off you by selling you the policy to get things started, and they make another probably 2%, which is 50 grand a year on 2 million in assets every year for managing. That would be an example. Everything will vary. So it's way cheaper to hire, even if it costs you
always way cheaper,
5 or 10 grand in that first year to get really good advice to get that up.
And for sure, that is the going rate on financial advice. If you want high quality, fee only financial advice, you should expect to pay a 4-figure amount per year. Something between $1,000 and $10,000. That's the going rate. Now, if you are paying, AUM fees, you're paying 1% of assets under management. You got, $3 million. That's $30,000 a year, every year. That's way more than the going rate. So as your assets climb, you've got to negotiate that AUM fee down, or go to somebody that charges hourly or a flat fee.
Great. Well, Jim, do you have anything else to add today on the discussion around life insurance here? Before we get out of here?
Oh, I would just caution people to learn about this stuff, have a natural bias against whole life insurance. Know that most of the time it's not right for you, but that there are situations where it may make sense, and it's okay to look if you're in one of those situations and understand it. But just recognize that you don't need it just because you make a lot of money or just because you're married or something like that. That's not a reason that everyone should have a whole life insurance policy. There's way too much information out there on the internet that seems to treat it equal to term life insurance. It's not equal. 99% plus of the policies out there that should be sold are term life insurance policies. When I have, the truth is about 80% of whole life insurance policies get surrendered before death. And this is something that's designed to be held for your whole life. So 80% of people are regretting it. When I polled my own audience of people who have bought these policies, 75% regret buying it. So,
well, I would argue that people are surrendering them and giving them up because they're following you, and you're probably in a lot of situations mischaracterizing the benefits of it, and doing the in-force illustration giving poor advice on surrendering the policy at that point in time. Because I could tell you, I agree, don't throw good money after bad, what they said earlier, but even 15 years into a policy, there's not a policy alive that's 15 years old that makes sense to surrender. If you've paid during that time, the policy for every dollar you put in at 15 years and beyond is going to be more efficient, right? Like the money going in versus how the cash is growing in the policy is going to be really, really efficient on a dollar for dollar basis. And so it just makes no sense. What I would love is to debate either of these people or to have a conversation, have an interview, and really have both sides of the conversation be public. White Coat Investor, you want to come on my channel, I'll go on yours. Maybe we do both. Bigger Pockets, like you guys, I know you have been talking about not liking whole life insurance, but all I can say is come bring the hardest questions that you have. Try to prove me wrong. It's not going to be a sales pitch. It's go watch my content. You'll see I don't have a sales pitch. Like I just focus on education because I feel like, unfortunately, most of this stuff is misunderstood. And what is understood is because of the fact that people have had bad situations happen to them. And there are, unfortunately, like these things happen, unscrupulous agents, uneducated agents, which is unfortunately most of the situation is uneducated people that maybe have good intentions that don't fully understand what they're doing. They hurt people, and that's the way it goes. And then the people that get hurt, like White Coat Investor and maybe like you guys, and maybe you've heard experiences from other people like that. Now it becomes an emotional conversation. And to me, the only emotional side in this is like, what do you want your life to look like? What problems do you need your money to solve? What do you need for your money to do for you in your 20s and your 30s? What do you need it to do in your 40s and your 50s as you start to age, as your health starts to wane, as you hit retirement, as you need, different piles of money to solve different solutions or different problems for you at different stages of your life? That's really the question. And I challenge anybody that no asset in the world, no financial product or tool in the world will do for you from a full spectrum view that whole life insurance will do for you. And I've shown the illustrations. I've shown exactly what it can look like. All his kind of worst case scenarios that he's preaching to are just like, yeah, those are bad situations. Those are worst case scenarios that I would say to everybody, do not get involved with policies like that. But you need to make sure that you're doing your own education. You are understanding what you're getting involved with, and reach out to somebody like myself or somebody else. It doesn't need to be me, but it needs to be somebody that knows what the heck they're doing. So anyway, hopefully you found value in this. If you did, please like it, share it, get it out there to people. I know this is a series. If you haven't watched the previous videos, make sure you watch the previous videos now. And I'll put the next one or one of the previous ones on the end screen here. Go back, watch it. Till next video, have a blessed, inspirational day. We'll talk soon. See ya.